All right, everybody, welcome back to the weekly rebalance. We got a great show for everybody today covering the K-shaped economy. Let's get right into it. Nick, how are you doing today?
I'm doing well. How about you?
You're doing pretty well. Can't complain. The market's at an all-time high again. Well, it
Yeah,
was.
it
Not
was.
anymore, I
We
guess.
were close.
We're still close, yeah. Uh, Friday, wild day. We actually got to an all-time high in the S&P and the Nasdaq again, just a little over a month after the bottoms from the issues in Iran. And
Yep.
we still got the conflict going on. We're now ninth week of the
Oh,
conflict. Oil's still high, geopolitical issues still dominating the headlines, and back to the high on the S&P and the Nasdaq.
yeah. Really surprising. I mean, and two, to think about the price of oil. I think last time I was looking at somewhere around $110. You know, I think earlier on when we were talking about this going on 9 weeks, because I think when we started the conflict, Trump was saying around 6 weeks. Everyone was saying the further and further we go beyond that, the more likely that we see oil push higher and higher. And to see oil trading around $110 a barrel, I mean, there's obviously a bunch of different um, markets where that's trading, and disparities in the prices depending on where you're trading it, that sort of thing. But still, seeing most of the headline oil markets trading at around $110 a barrel, kind of surprising.
Yeah, exactly. And the market's kind of looking right past it and on to the
Yeah,
next one. And and we saw, last week, I know we're already a couple of days into the next week, but looking at last week in general, we saw some leadership from a lot of the top market cap weighted
yeah,
indices, like the S&P 500. We saw actually some of the more value indices kind of underperform and saw growth kind of surge a bit, which, lines up with the Nasdaq reaching another high since that's a very growth heavy index. Very, um, I guess, nuanced returns here last week, and a lot of things have changed on the year-to-date picture. The S&P is now positive almost 5%. Mid cap and small cap, though, continue to surge. I mean, look at that number for the mid cap, positive 10.5% for the year, and
yeah.
small cap positive 13.5, more than 13.5, 13.6%. Really doing well. All of them, of course, losing to emerging markets, which is positive 15% year to date. Really leading the way there. But developed markets as well. The MSCI World ex-US now kind of reining in its lead. It's still leading over the S&P, but reining in its lead that it had earlier this year, which was pretty extreme at one point. So lots of changing elements here in the last couple of weeks.
Absolutely. And I mean, we've got earnings tomorrow for a lot of the Magnificent Seven. So it's going to be interesting to see how markets react to that, especially with, like you said, I mean, we've seen a lot of those NASDAQ names, some of those Magnificent Seven names really rally back here very quickly recently going into earnings season. And so, again, we'll see what happens following earnings. I mean, we got some interesting news out of OpenAI today, or I think it was OpenAI, where
Yeah.
basically just adoption, not necessarily where they were expecting it to be, and saw a lot of chip manufacturers drop on that. Nvidia not necessarily having a great day, of course, after rallying a substantial amount. So, um, yeah, I guess we'll see if things hold up after we get earnings.
Yeah, yeah. Earnings is the story that's really driving it all. I mean, I feel like we're looking past the conflict in Iran and looking at earnings. And the truth is we are seeing good earnings.
Yeah,
I think as of Monday morning, but 139 companies of the S&P had reported. Again, we got a big week this week, but before this week, actually a lot of the big ones are tomorrow, Wednesday. With tomorrow, you've got Microsoft, Meta, Alphabet on Wednesday, and then Apple and Amazon on Thursday. But even before that, 139 companies of the S&P 500 reported, which is about 26% of the market cap. 80% had beaten estimates, which is well above the post-pandemic average of 78%, and the long-term average well above the long-term average, which is 65.8%, which is goes back, that's the average from 1992 forward. So the aggregate earnings growth is tracking at north of 12%, which I mean that's hard to ignore, and a lot of that is driven by earning strength from AI spending, but not just concentrated in those particular companies like Microsoft, Meta, Alphabet, Amazon, Apple. It's really broadening out, and the rest of the economy is participating in some of this growth and continued revenue growth and continued earnings growth. So that story is really hard to ignore. That's what drives a lot of stock market performance. So continued beats is very positive for the market.
Definitely. Yep. Going to be a good thing to keep an eye on over the coming days. I think the other thing too that's interesting to note in terms of just overall market update kind of news, I, utilities still leading the way in terms of sectors within the S&P 500 with year-to-date return or energy. Sorry, energy still leading the way, at least as of yesterday, up about 28%, leading materials, which is the second highest return year to date by more than 10%.
Yeah. Yeah.
So we've talked about that a lot with energy related to the Iran conflict, but still kind of surprising.
Yeah, yeah, definitely. And shifting gears a little bit to fixed income. Fixed income has also been something to watch. We're clearly in a bear steepening environment, meaning the rates have risen generally, but the differential between short and long term has it's steepened, the long term going up more than short term, right? That gap has widened. Um, and so that's kind of what's been happening in fixed income, which is why fixed income returns have not been phenomenal for the year. I think the ag is positive 0.5%, and that's about it. But a lot of uncertainty around the Fed and their policy going forward as well. You had some uncertainty around the transition from Powell to Warsh. That's kind of gone away, at least from my perspective. The investigation around Powell has dropped, so he's gonna, likely this is going to be his last meeting, this Fed meeting, and then Warsh will take over. And but a lot of the commentary from the Fed will be very interesting to follow this coming week because they're dealing with a lot of different issues, right? They're dealing with potential inflation from the conflict in Iran. They've got great earnings growth. Some reasons there's reasons to cut and reasons to raise rates, likely to hold at this point, but some uncertainty at the moment that wasn't really there at the beginning of the year. The beginning of the year was much more clear that it looked like they were going to cut into this year, and that has certainly changed now that we're into April and almost into May.
Yep. And I think that's actually a great point to kind of transition to our main topic for this week, which is basically the reverse wealth effect and how we've got an interesting split in the consumer, at least particularly within the US. And that all ties into the difficult situation that the Fed is navigating here.
Yeah, exactly. So yeah, so getting into the research of the week, the wealth effect, the K-shaped economy, and then diving into a little bit of specifically to one of our companies that a lot of people are starting to notice now, which is Affirm, the buy now, pay later. Yeah, introduce that for us, Nick, and what's it? Let's set the stage for us.
Yeah, I mean, I think big picture, basically, we've got two segments of the economy that are performing very differently. We've got higher end, more wealthy consumers that are, faring through a higher inflation, higher borrowing costs. They're faring better through it. They're able to continue spending. And at the top level, we actually see, consumer confidence. We had consumer sentiment readings come out today, and they were actually up a little bit. A number of metrics at the top level, just at the aggregate of the U.S., are actually pointing towards that the economy and the consumer, the U.S. consumer, is pretty strong. But what that doesn't highlight is underneath that surface, we've got one set of consumers that are doing very well. And are able to stomach all of this additional inflation, higher costs, higher borrowing costs, so on and so forth. And then we've got another part of the economy that's really struggling, living paycheck to paycheck, and being particularly impacted by the higher borrowing costs. Um, and so basically, that's the other thing. And Powell talks about this a lot in his commentary, and we've heard a lot of questions about it. But basically, how do you manage an economy that at the top level, unemployment rates are looking pretty good. Um, a number of metrics are looking really good, but underneath the surface, we know that there's a segment of the economy that's really struggling and a segment that's doing very well, that's kind of propping up the aggregate.
Yeah, totally. I did a little bit of digging on this just to figure out some context for how extreme it is. So household net worth hit a record $180 trillion this year. And but we still have this issue. 40 there's a lot of buy now, pay later going on. Actually, and actually 47% of buy now, pay later users had a late payment in the past year. And 25% are now using buy now, pay later to buy groceries, a week to week expense.
Yeah.
And when you dive into the numbers,
Ethan, can you hear me?
oh yeah, I can hear you. Nick, you still there?
I'm still here.
Did you lose me for a second?
I did lose you for a second.
Okay, where did you lose me?
Uh, Groceries, buy now, pay later, and people using
Oh,
buy now, pay later for groceries.
gotcha. Okay, you only lost me for a second then.
Yeah.
So 25% are now using buy now, pay later to buy groceries. When you look even deeper, and some of these are estimates, right? They're all estimates, right? There's no way to have this perfect, but these are the numbers that I came up with. Every dollar of increase in stock wealth leads to 5 cents more marginal propensity to consume. That's up from every dollar increasing the propensity to consume by about 2 cents from 2010. And then every dollar increase in household housing wealth, the value of the home, leads to a 4 cent bump in consumption. It's sounds tiny at first, but when you think about that, basically the top 20% of America's wealthiest households own 93% of all stock, and the top 20% of households have about 70, north of 70% of total household wealth. It gets a little scary when you realize how much of the economy is driven by the consumer, but it's being driven by these top tier consumers, the top earners, and not just the top earners, but the top owners of stock, real estate, houses, all of that. Those people are spending and driving the economy, and that's growing massively. But the bottom percent of earners are really struggling to keep up.
Yeah. No, it's definitely something to note. I mean, again, and how that ties into, let's say that we have a correction here at some point, like we had AI names pull back pretty notably. A lot of this growth that we've seen in the stock market has been coming from these AI names. It's been growing really rapidly. And as you mentioned, each dollar increase in stock wealth now generates about 5 cents in consumer spending. If we do have a correction in a meaningful amount, some of that support goes away at the aggregate level, and we begin to see that a little bit more pronounced. But certainly, certainly something to watch, and definitely important to note that uh, you know these wealthier households are supporting spending by a lot, and there's a consumer that's really struggling right now.
Yeah, the numbers that I was able to come up with are the top 10% account for about 45% of consumer spending, which is up about 10% from where it was 30 years ago. So 10 percentage point increase in the share that the top 10% are contributing to consumer spending. Again, consumer spending it's a huge part of the economy, but the bottom is really, really struggling. And that's where we get into the buy now, pay later issue.
Yes, for sure. Well, transitioning over to that, so I know you're going to talk about a firm and how I think everyone's noticed more frequent um, purchases offering the option to do a firm at 0% or stretch it out further, and um, that usually comes with some sort of an interest payment. But yeah, from your personal experience, how much have you seen that come up with your personal purchases, just out of curiosity? Because I tried to buy, I was going to get 3 T-shirts this weekend because I wanted to get one for my dad for his birthday and what have you, but ended up being like a $60 order or something like that. And they offered to affirm the $60 T-shirt purchase,
Yeah.
which was kind of a wake up call to me because, I've gotten it on a few like trips that I've been planning, things like that. Larger purchases where it kind of makes a little bit more sense, but seeing it pop up as an option for a $60 purchase was a little bit jarring.
It's everywhere nowadays. And yeah, it's surprising. Like it makes sense to me when you're looking at purchasing like a Peloton or a big trip or something like that. And it's 0% financing,
Yeah.
right? For 24 months or something like that. You can get on board with or understand that. Like, okay, use Peloton as the example. Peloton doesn't want to get into the financing business, so they kind of outsource that to a firm, right?
Mhm.
And then, it's 0%. So,
Yeah.
all right, free money.
Yep.
But when you're using that for a $60 t-shirt, I know you didn't, right?
Yeah. Yeah. Yeah.
But when that's being offered, it is kind of scary. And that was the scary part about reading that. What was the number? The number of people who are using it to pay for groceries. I
Yeah.
mean, how are you buying now, paying for groceries? You consume those groceries and then you need to um, buy groceries again next week. So when are you paying for it?
Yeah.
At 25% are using buy now, pay later to buy groceries of the people using buy now, pay later.
Yeah. And I mean, I don't doubt that those people are kind of in a hard way right now. I mean, we've seen grocery costs just continue to skyrocket, gasoline prices continue to increase. Um, you know, housing expenses continue to increase, rent. Um, I don't doubt that there's reasons for why people are doing it, but it definitely creates a lot of debt out there that could potentially snowball and create personal finance problems, and then also just problems at the economic, just the entire U.S. economy level.
Yeah.
Uh,
Well, about 40% more for like the essential basket of goods, things like bread, eggs, beef, soft drinks, etc. That basket is now 40% more expensive than it was in 2021, which not a big if you make $500,000 a year and your stock portfolio is worth, $4 million, do you really care if your grocery bill went from 400 to $500? I mean, you might not even notice. You're probably not even noticing it, right?
yeah,
But if you're making, I forget the average household income in America exactly, but it's somewhere around that like 60,000 to 50 to $60,000 a year. Well, that's a big deal to you. And
yeah.
that's where a firm comes in. And I had to do a little digging. Do you know how a firm makes money?
Isn't it they get like a fee for facilitating the purchase from the vendor, right? It's kind of like a credit card. And then if there's any interest that's involved, if they stretch it out, then they get that. But it's like it's mainly based on the transaction, and they get a kickback from them.
Yeah, exactly. So let's dive into that really quickly here for those that don't know, because I had to look. Um, I wasn't certain exactly how they made money. I knew how credit card companies make money, and I was assuming
Yeah,
it was somewhat similar business model, but I know credit card companies make a lot of money on charging interest, and I had
yeah,
always seen the 0% interest offering from a firm, right?
yeah, yeah,
So I was kind of curious. So yeah, the biggest thing is merchant fees. So in the Peloton example, Peloton's actually paying a firm a fee, and it's typically 4 to 6% of the purchase, which is similar to credit card interactions, but quite actually
yeah,
similar in the concept, but notably higher than most credit card transactions.
yeah.
So that's the main thing. The merchants want to pay it to boost conversion rates, increase average order values, and go from there. So that's the main thing. They do have the interest income as well. So a lot of the longer term, larger ticket loans have financing, and that the financing charges can be notably higher, high, just depending on the credit worthiness of the person and the different offer that's going on. But that is, that's definitely part of it as well. And then the last part here is servicing. That's a newer thing, but they actually are kind of launching this. It's the newest product is the Affirm card, and it basically generates a traditional debit style interaction where you can use the card like a regular card and then use the pay over time fees when users convert specific purchases into like an installment plan. So that's a new part of the business. But by and large, merchant fees are the big thing that a firm is making money on, and they're charging somewhere between 4 and 6%. So notably higher than credit cards, and which makes sense because the credit card companies make a lot of money on interest. A firm has a lot of charges that are at 0% financing, so they're needing to charge a little bit more on the transaction volume to get compensated. But that's how they're making money.
Yeah, and I find that interesting too because I've done one a purchase with a firm, a larger purchase that I did where I did a 0% interest to firm payment plan on it, kind of to try it out, but also it was just appealing. 0% interest for a year on a larger purchase. You can invest that money and you know basically save some. Um, but I think the interesting thing to me is they had a 1 year and a 2 year option. I think the 2 year option was also offered at 0% interest. And if they're only making 4 to 6% on that transaction fee, in theory, they might be 4 to 6% over a year. That's probably better than a treasury. Well, at
Yeah.
least right now. But over 2 years, that sounds to me now. I'd imagine there's something else in the background that they're making a little bit more if you do 2 years or whatever to work that out. But just hearing 4 to 6% and thinking about that 2 year offer that I saw, they're probably not making much more than treasury rate of return over that time period. I'm sure they're getting kickback somewhere else, and it makes complete sense. But at the top line,
Yeah.
that's one of the things that jumped out to me.
Yeah. Well, it's interesting about this. Most of the loans are being sold. They're not,
That,
the firm is not holding most of their loans on the balance sheet. So they're actually originating and then distributing.
that
So
makes
they're
sense.
not, but you're right. Still, maybe more people are leaning into the interest bearing loans though, and those interest rates can be notably higher. And then they're getting again the risk is really being transferred into the asset backed securities market. So these loan a firm barely holds any of the loans on its actual balance sheet. It's really originate then distribute, and then they sell the loans the ABS market, the asset-backed securities market, and that's it. So I mean, a little bit, in my honest opinion, a little bit concerning. You're relying on a firm to not get the underwriting wrong, and I mean, just how much a firm continues to, you know, basically say that their borrower base is near prime or and
Yeah.
not a huge part of the borrowers are subprime. But I don't know, for some reason I'm not confident in that.
Yeah. Well, I mean, and to get in a firm loan, like they only do a soft inquiry on your credit. I
Yeah,
think unless you're doing an interest bearing option, they only do a soft inquiry, and I don't even think it hits your credit report at any point. At least in certain circumstances, from what I was seeing. So yeah, there's probably a decent amount of debt. Again, maybe at 0%, maybe you don't want to call it debt, but I guess it's still an obligation. But there's probably a decent amount of obligations out there that maybe aren't necessarily being factored into credit quality of the end consumer.
yeah, yeah, exactly. Well, so that's a firm. There are other options in the buy now, pay later space, but I think Firm is the biggest, right?
Yeah,
But there are others as well, Klarna and
yeah,
others as well. You know, getting back to okay, the issue of the K-shaped economy. Some stats on, I guess, the warning signs of the buy now pay later, and this was really the I'm not gonna I would say the concerning part, right? So I have a couple stats here for you.
Yeah.
Um, since 2021, the buy now, pay later transaction volume has grown 20% per year since 2021. It's now $70 billion,
Wow.
and which is about 1.1% of total credit card spending. 61% of buy now, pay later users have subprime or deep subprime credit scores. 25, I already stated this, but 25% of US consumers now use buy now, pay later for groceries, which is uh, double, almost double the rate from a year ago. A year ago, the rate was about 14%, so it's almost doubled from a year ago. And 54% of buy now, pay later users say they couldn't make ends meet without these loans.
Yeah.
Rising to that rises to as high as 62% among parents with children under 18. And then 47% of buy now, pay later users paid late on at least one loan in the past year. And 63% of buy now, pay later borrowers take out more than one buy now, pay later loan at a time. And 33% are taking loans from multiple companies. So they're kind of stacking loans.
Yeah.
Which all of that is really scary if you think about it.
Yeah. It's definitely something to be concerned about. Um, there's a lot of it out there.
Yeah.
There's a lot of it out there. And I think there was just one other thing I wanted to share because we got data on this today and I thought it was interesting. We got the Consumer Confidence Index read today, and it was better than expected. You know, here we've got a chart of it, the Consumer Confidence Index for the US going back to 2007. And you can see basically since 2020, we've been trailing off slightly with some spikes, but kind of trailing off. And then here recently, we've seen it continue to increase for a little while here. And I mean, particularly coming at this point, you know, we were talking about the K-shaped economy. We've got certain consumers struggling. Uh, Oil prices continue to climb, grocery prices continue to climb. Kind of surprising to see this consumer confidence index hold steady and even make gains um, at this point in time.
Yeah.
So, yeah.
The funny thing is, typically, if you look at the bottoms in consumer confidence, the ironic thing about that, you see the bottom of consumer confidence, 2020, 2009.
Yeah.
They oftentimes coincide with the beginning of a very strong bull market in the stock market. It's kind
Yes.
of a counterintuitive indicator, but kind of funny how that tends to occur.
Oh, yeah. No, I mean, absolutely. Uh, you know, got a lot of room to gain. Uh,
Yeah.
so, anyways, I found that interesting. Another good data point to watch. I mean, it is a leading indicator. The other thing that I found really, this was the main thing I wanted to bring up because, again, we're talking about the bifurcated consumer in the US. But the breakdown in the demographic and the reads that they were getting from different generations on the consumer confidence index. And it was the opposite of what I would have expected, especially given our conversation earlier. So
Yeah.
the millennial generation and Gen Z are actually the only ones ticking upwards here, while all of the other generations trailing off.
Interesting.
And you know,
Wonder why
these are
that
the
is.
type of consumers that are more likely to be using those buy now, pay later programs. They're likely the ones that have less home equity to tap into, take advantage from of rising housing prices, and also likely less have less assets in the stock market just given their age. Um, so I find that really interesting, especially tied to our conversation we were having earlier about you know, buy now, pay later utilization rates.
Yeah, that is fascinating. I would not have expected that. Where do you get that data? That's very interesting.
Yeah, the conference board.
Okay.
Yep,
Huh.
it's in the report. Great report. Check it out. But a lot of good interesting data here. But this was really the surprising thing that I saw today when I was taking a look at it.
Yeah, very interesting. Not what I would have expected.
No, certainly not. And then I think the other thing too, because uh, this is another data point that they collect with their study, but this is the amount of spending, or do consumers expect to spend more on these categories in the coming months? And even though that we've seen the consumer sentiment reading continue to climb, we've actually seen over the past few months here, we've seen expected spending on these categories we would expect to probably increase if people are really expecting things to be better in the coming months trail off. Household maintenance down a bit, fitness and gym down a bit, airfare, trains, personal travel down a bit. I think that one's a little bit more telling than maybe some of those other ones that might be a little bit more cyclical. Um, but kind of interesting because not really what you would expect. You wouldn't expect things, expected spending to be trailing off while you also see um, consumer sentiment as a whole increasing.
Yeah.
So
Hmm.
some good stuff in that report, but
Yeah.
found this most intriguing. Who knows? Maybe those buy now pay later programs are maybe skewing perceptions from these generations and thinking that things may be a little bit better than they already are because they're deferring spending on necessities. Um, Potentially those two things are tied together there, but
Yeah,
who knows?
definitely. Well, what else you got? You got any other interesting stats on that, or should we bring it together and go into trivia?
No, let's roll into trivia.
Sounds good. Yeah. Lots of stuff to pay attention to there. Probably not stuff that unwinds or plays out over the next like couple of months, but more like over the next couple of years, or maybe even the next 5 to 10 years. But it's concerning the overall level of consumer, spending, how dependent it is on those top 10 to 20% of households, how much that is connected to rising asset prices, and the buy now, pay later issue. Is that going to create issues in the future? We'll have to see. And I don't think it's something that plays out over the next, 6 months, maybe
Yeah,
the next 6 years. But we'll have to have some update episodes on this into the future.
certainly.
Mhm.
Certainly.
All right. I got a couple trivia questions for you.
All right, let's do it. You start with one, and then I'll follow up with one.
Okay, sounds good. Well, mine is let's see. Um, I'm gonna ask you some Affirm specific trivia since we're going
Oh boy.
all through Affirm today. I would be very surprised if you get these, but I'll be incredibly impressed if you do. So,
Okay. Okay.
all right,
Let's roll.
Affirm's founder, his name is Max Levchin. Sorry if I'm pronouncing that incorrectly. I did my best. He's part of the original PayPal mafia. Before founding Affirm, he founded another company that he sold to Google in 2010 for $182 million, only for Google to shut it down a year later. Do you know what the company was?
Um, was it? I mean, I'm guessing it was a transaction-based kind of company. No,
Uh-huh.
no. Well, I have no idea. I feel like honey is still a thing. That would have been my guess, but that's still a thing, and that's been a thing for a while.
Yeah.
I have no idea.
Like I said, I'd be shocked if you got this. Because I didn't know it either, and but it is interesting that he did this. So Slide was the company.
Okay.
It's a personal media sharing service for social networking sites like MySpace and Facebook. It was sold to Google in 2010 for, like I said, $182 million, and then it shut it down about a year later, on August 26, 2011.
Oh,
And but another interesting fact about him, he also created the Gauss spec. Levchin test, which is one of the first commercial CAPTCHAs, one of the
Oh,
first commercial CAPTCHA implementations. Um, so he basically started the "I'm not a robot" test,
okay,
or
very
helped
nice.
invent it.
Very nice. Very nice.
Interesting
Hopefully
guy.
he wasn't the one that asked you to pick all the pictures with a bicycle or something like that.
I'm not sure if he was the one or not, but he was involved somehow.
Very nice. Well, that really is interesting. Affirm and PayPal have linkages. Guess that makes sense.
Yeah.
Common, common founders. All right, let's see here. I've got some more about the U.S. consumer, the economist's favorite. All right, let's see here. I'll start with this one. What percentage of Americans could not cover a $400 emergency expense with cash or savings?
What percentage of, oh, yeah, it's like shockingly high, isn't it?
Yeah.
Uh, 50%.
Not that high, luckily. Luckily, not that high.
I'm
37%.
overcorrecting.
Still really up there. Um,
Yeah,
yeah,
37%.
yeah, it definitely a high number, and who knows? It could have increased since then.
Yeah. Well, it's playing right into that issue of the buy now, pay later thing. So you can't pay for that expense. The option comes up and you have no choice but to choose it. The buy now, pay later option.
Yeah. Yep.
Yeah.
It's certainly
Interesting.
one, at least short-term solution to the problem.
Yeah. I heard a funny, it's not funny. It's not funny, but it's interesting. I heard a story last night, somebody was telling me, where they were, this is sad, but it was somebody in like a government housing situation.
Mhm.
And the guy I was talking to went in there to help them with something. And they needed money so bad that they had pulled the stainless steel sink out of their
Oh,
counter and were trying to sell the sink.
oh man. Yeah,
Yeah.
that's tough.
Well, buy now, pay later, better than that.
Yeah, probably better than not having a sink.
I shouldn't be laughing at that. It
Yeah,
is
that's a
sad.
tough situation. Yeah,
Yeah.
that's an extreme one.
I
Well,
was hearing that story and I didn't know what, I don't know. It's hard to react to that. It's
well,
just
yeah,
sad.
no. I mean, yeah, it's one of those things where it's kind of a shocking revelation. It's
Yeah.
sometimes a natural instinct to laugh, and then you think about it for a minute. But yeah, that's tough. I mean, and again, just highlights the situation that we're in. I mean, we've got one part of the economy that's struggling and having to do things like that to get by, and then another part that's kind of propping things up, and at the top level, everything looks all right. So, um, yeah, just serves to highlight that further.
Yeah. Yeah. Oh boy. All righty. Well, I got one more question for you if you want.
Let's do it.
All right. I don't know if this is true or not, but there's a famous story about the Affirm founder, Max Levchin, about
Okay.
how he started Affirm. It involves him being denied for for a particular loan. And
Okay.
then he ended up flying anywhere there and buying it. Um, but what did he get denied for that inspired him to launch Affirm?
He flew somewhere to pick it up,
Hmm.
and he wanted to get a loan for it. He's pretty wealthy.
And he got denied, which is funny since the guy sold his company to Google for $182 million. The
I
fact
don't
that he's
know.
getting denied a loan at
He's
all
got
is,
kind of an interesting last name. I'm gonna guess something like a horse. He wanted to buy like some racing horse or something.
yeah. No, it was simple. It was a car loan. He wanted a
Okay,
Mercedes.
a Mercedes. Come on, you
Yep.
should be able to just buy that Mercedes.
Well, he did. He flew down and bought it anyways in cash. But apparently, at least according to the story that
That's
I read.
crazy. They denied him a loan on a Mercedes.
Yeah,
A guy like
interesting.
that. Wow.
But according to the story, That's the founding story. And that's why you started a firm. Now, how true is that? I don't know. Sometimes you hear these founding stories
Yeah.
and you kind of wonder. Like I heard this recently, the founder of Ferrari, Enzo Ferrari, that he used to say, the car, I build engines, the rest of the car is free,
Yeah.
right?
Yeah.
And that I also heard that which might have been true, and I also heard that he didn't care about selling cars at all. All he cared about was racing. But
Yeah.
that's totally not true. Of course, cared about selling cars. He was a
Yeah. No, I've
business
heard that as
person.
well. I know that. Yeah. There's that rumor that racing came second to selling cars. They've definitely moved away from that. I mean, who knows? I love the Lamborghini story tied to Ferrari.
Yeah. Oh, the tractor story.
Yeah, yeah. How he said, "I fixed your car
Yeah.
with a tractor clutch," and yeah, I love that one. That's my favorite founding story.
Yeah. Well, sometimes these founder stories are not necessarily always 100% true, but it's a
Yeah, I'm sure there's a
good
little bit of
story.
embellishment.
From what I read on the Ferrari story, that racing was primary and selling cars was second, just to go racing was the story to sell to the U.S. market.
Yeah, I. It's kind of a neat story to sell.
It is. It's a great story to sell, but how true was that? Who knows? And how true is this story about him getting declined a loan for a car when when he's worth hundreds of millions of dollars? Of course, maybe this was before. Who knows? But I kind of doubt it because if that was the impetus for founding a firm, that was after the selling slide to
Yeah,
Google. So
yeah,
unlikely that you're getting, in my opinion, unlikely you're getting denied a Mercedes loan when you sold to Google a couple of years earlier for 180 million.
yeah. That's interesting. That's interesting. But it makes for a good story.
That's a good
Um,
story.
I do have another trivia question, but I'm actually going to skip it because it's just kind of a bummer, and I'd rather end on a high note with that more fun founder
Sounds
story discussion.
sounds good. Well, yeah, that's good. Yeah, some of the topics today are certainly a little bit scary and depressing and sad, but hopefully we can turn that around as a country over the next coming couple of years and not have such a bifurcated economy.
Yep, definitely. Well, I think that does it. We'll wrap it up here.
Sounds good. Thanks, Nick.
Thanks, everyone.
Bye.